You've made every payment on time for 5 years. You've worked overtime, cut back on vacations, and played by the rules. You've done everything right. But this month, when you open that long-awaited mortgage renewal letter, it's not an offer. It's a rejection. Welcome back to the Canadian Wealth Lab. We are entering a phase of the housing cycle that most Canadians haven't seen in 40 years. It's no longer about how much you'll pay. It's about whether the bank will let you pay at all. Across parts of the GTA, some 2022 buyers are now sitting on negative equity for the first time since the early 90s housing crash. In some condo segments, values have dropped so sharply that recent buyers owe significantly more than the property is worth. Thousands of homeowners are now discovering that a bank can actually refuse to renew your mortgage, even if you've never missed a payment. Today, we are performing a lab check on the renewal refusal trap. We're breaking down the hidden math that triggers a bank exit, why your equity might be working against you, and the 3 survival steps you must take immediately if your lender says no. Reason 1: the appraisal gap. In the exuberance of 2021, many buyers entered the market with a 5% down payment. Let's run the math. If you purchased in the GTA for $800,000, you likely had a mortgage of $760,000. 5 years later, you've brought that balance down to maybe $700,000. On paper, you're winning. But here is the reality check. If your local market has corrected by 15%, that $800,000 home might now only appraise for $680,000. You owe the bank $700,000 on an asset worth $680,000. Your loan-to-value ratio is over 100%. When you go to renew, the bank's automated systems flag your file immediately. They aren't just looking at your credit, they are looking at the collateral. In a falling market, collateral is everything. If the house doesn't cover the loan, you are an unacceptable risk. The bank's primary concern is their margin of safety. If the math doesn't protect the lender, they don't want to renew you. They want you off their books. To the bank, your family home is no longer a home. It's a risk calculation. Reason 2: the debt service wall. In 2021, your 1.9% fixed payment was roughly $2,300. That fit the stress test. But today, with the Bank of Canada holding at 2.25%, your renewal rate is closer to 5%. That payment jumps to $3,400. That is a $1,100 a month tax just to stay in the same house. That's $13,000 a year in after-tax income simply gone. If your income hasn't kept pace with inflation, your debt service ratio may now be in the red zone. To the bank's computer, that makes you a high-risk borrower. Even if you have the cash, the regulations might stop the bank from saying yes. If they renew you, they are technically holding a non-compliant loan. In a tightening credit market, you are the first person they ask to leave. They are no longer looking for reasons to keep you. They are looking for excuses to insulate themselves. Reason 3: the lender pivot. Some smaller lenders and MICs are pulling back from specific regions to reduce exposure. This is a cold, strategic rebalancing of their portfolios. If your lender decides they no longer want to play in your city or asset class, for example, high-rise condos in Toronto, they simply won't send an offer. They will send a letter stating your mortgage is due in full on the maturity date. This isn't personal. It's a portfolio re-weighting. But for you, it's a crisis that requires an immediate, high-stakes solution. What do you do? If you're refused, your clock is ticking. You generally have 30 to 60 days to act. First, look at the credit union pivot. They are provincially regulated and often have more flexibility than federally regulated big banks. They might look at your extended amortization to keep you afloat. Second, consider a lump sum injection. It's painful, but paying down the principal by even $30,000 can sometimes bring your loan-to-value back into a safe zone where the bank is willing to keep you. Third, the private bridge. This is survival financing. Brutal rates, but it stops a forced sale and buys you a year to find a co-signer or wait for the market to stabilize. These are short-term bandages, not long-term fixes. But in a crisis, time is your most valuable asset. The renewal wave is here. Don't wait for that letter to arrive. I've built an equity stress test spreadsheet in the description below. Run your numbers now. Because in this housing cycle, the real danger is no longer missing payments. It's becoming a borrower the bank no longer wants. This is the Canadian Wealth Lab. Know your numbers before the market forces you to.